Is it time to sell the rib? We're noticing a pattern here which led to the last corrective wave on the S&P 500, and we're starting to get some warning signs. So that's exactly what we want to talk about today. The potential that the yellow box is repeating and that could lead to a corrective wave. Notably because we are back below 430, and as we know, we want to be mindful of this quote from Warren Buffett. So today I'm giving you a warning because we're starting to see evidence, but we are not seeing confirmation. So we'll come back and talk about the quote, which we've been talking about for a while, but please bear with me because if we look at the one-day performance, we know that chips lead tech and tech lead SPY. Well, what's the reddest group today? It's chips. And what do we note? Well, chips are pretty red and technology is not doing that great. If we now zoom out to the last week or the last 5 trading days, what do we note? Technology is largely red. Meta is green, NVIDIA is green, but the problem here is that the leaders are leading, but the followers are not following. These blocks are largely red. So this is where we have to contend with the stock market's rah-rah mob confronts February's weak record. What does this mean? It means that this month is historically among the 3 worst months for equities during the year. Over the last 30 years, February is not usually all that great. So we want to be very mindful of that on today's show and hopefully watch until the end because I want to leave you with some insight. We talked about how we had Jerome Powell talk on Sunday. Market shrugged it off. We have no critical earnings reporting this week, but it's giving us a good grip on the economy. And as of right now, the leaders are not really dragging us higher, which means the market is marginally red on the week. We also have a 10-year bond auction tomorrow that we don't want to forget about because this is going to likely be moving the market. If there's appetite for it, we're likely going to do well. If there's not appetite, it could bleed through into Thursday when we have that 30-year auction. All right, I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel. Thank you very much ahead of time. You guys have been such a great audience, and I truly appreciate your support. All right, so now let's talk about why we want to be a little bit more mindful of this, this headline here where February usually sucks. So is it going to suck this year? Well, it's not been a normal market. So if you look here, we were supposed to close down in January. We did not. We're supposed to close down in February. We'll see what happens. But what this basically signifies here is a failed breakout. We form a higher high, and then we actually lose it and close below. So in a typical year, not including presidential cycles, normally the first 3 months of the year are fairly soft, and then we rocket higher. If we look here to the election cycle over the last, all the way back to 1950, what do we do in the first quarter? Nothing. We go sideways. So the odds, if we're in a normal election cycle, is that we should be going sideways. But as we know, there's something else in the mix, which is actually making this a lot more complicated. What is it? It's the fact that we have a recent pivot from the Fed, actually pausing rates, where if Powell declared victory on inflation, we could be seeing continuation just like we did with Volcker, where we go higher and higher and higher and see continued strength, going all the way into roughly April. This would track what we did back in the 1980s. So what is it? Is it the 1980s? Is it a presidential cycle? Or is it the normal seasonality chart? Oh my goodness, this is getting complicated. Yes, it is. And all we're doing is looking at QQQ. What I want you to be mindful of here is that if we now look here to our monthly chart, what do we have? Well, it might not be very obvious, and we're still early into the month. Let's go here to full candle so it's a little bit easier to see. Last month's high, 429.85. Where are we right now? We poked over 430, but now we failed to hold it. By definition, that is a failed breakout. So what does that mean? It means we made progress to the upside, but failed to hold it. So we broke higher, but failed to hold it. I hope that makes sense. We talked about this a lot on the weekend. But what is the confirmation we actually need to see? We've been talking about this. We need to see a monthly lower low. So a failed breakout could be a topping pattern, but we're not going to get confirmation until we actually slam all the way down and lose 395 on QQQ. And if we pop over here to SPY, we need to lose 466, which is going to be our monthly lower low. So if we're above 466, as of right now, we're not getting any confirmation that we're actually getting a breakdown. So again, I'm showing you that we're getting a early warning signal. We do not have confirmation yet. The trend is still up. So for the S&P, we could drop down by roughly as much as about 5%. The reason why I'm saying this is because we often talk about what we're going to regret. So if we go here to our template in terms of what we could regret, let's just find that quote. What we talk about here is the fact that people typically fall into bucket number 1 or bucket number 2. So if we slam down roughly 5-6% to 467, are you going to say, oh my God, I bought stocks and they went lower. Oh my God, I did not sell or trim and we went lower. yeah, that's going to be regret. You're going to regret not selling and the stocks go down. But on the flip side, if we continue this move right here and you trim or sell here, are you going to say, oh my God, why did I sell? I didn't buy and the stocks went higher, or I sold and they went higher. So most people typically fall into bucket number one, myself included, which means that I'm skeptical right now. I'm cautious. And when I look at the risk reward that we laid out on the weekend, it doesn't get me all that excited this week. And I'll talk about specifically what that means. If we look here to our support and resistance, from the close that we had last week at roughly 495, we had about 5 points of upside to resistance 3 at 500, or the round number. But we have to drop down by roughly 15 points to get to that annual good level at 480, which means roughly 15 points of downside for roughly 5 upside. That doesn't sound all that appealing. No, it doesn't. But here's where we're going to look for confirmation. So if we look to our 1-day chart, SMH, again, if chips lead tech and tech lead SPY, what are we noticing here? Come on, TradingView, it'd be great if you could load the chart. There we go. So we have the first warning sign here where we have a bearish engulfing candle, but we don't actually close below the low. So this could be a topping pattern, just like we have here. A full candle leads to a corrective wave. A full candle could lead to a corrective wave. So chips were the softest sector, as we noted on the heat map. If we now look over here to QQQ, what happened? Because we want to look at this chart, and then finally we're going to look at SPY. So what do we note here? Well, we have a higher high and a higher low. By 22 cents, we saved it. So technically a failed breakout, but also a higher high and a higher low. We also now have 2 back-to-back red candles. Why does this matter? Well, remember, the pattern on this chart is 3 back-to-back red candles. So tomorrow would form the third one. And what that basically means is that if we're going to repeat the yellow box, which again starts by forming 3 full candles. So far we have 2. So if we get 1 more tomorrow, again, please, please, please be mindful of that. It's very, very important. So semiconductors are looking a little bit soft on the 1 day. The NASDAQ is looking a little bit soft if we close red tomorrow. And now if we pop over here to SPY, here's the part that's a little bit tricky, because we talked about a failed breakout, but the S&P actually back tested and passed 492. So the low of the day today is 492.05. That is a save by 5 cents. So if we're truly going to go into a corrective wave, so far we have semiconductors looking a little soft. We have QQQ ready for a breakdown, but not yet confirmed. We're going to have to see the S&P fall below 492. And that's pretty much it. It's not a very complicated story. And the second thing I'll be looking for is to whether or not we can actually reclaim 75 on fear and greed, or if we start going down. If we recapture 75 and QQQ is above 430 and the S&P is over 492, we're likely going to see continued strength. So just be very mindful of that. We're right here at 73. We're so close to getting over, but have not quite done it. All right, that's it for today's show. So I left a lot more information on the weekend video. That's now queued up here on the left-hand side. If not, maybe you want to subscribe and hang out with us tomorrow at 9 a.m. when we go through the stock market open. Thank you so much for tuning in. I'll see you tomorrow.